Anxiety over tariffs and government changes are fueling growth concerns in the world's largest economy, extending a multi-week stretch of volatility across global markets. I'm Michael Drozd, Chief Investment Officer for LaSalle Street. Stay tuned to learn what a potential growth scare means for your investments and why periods of market volatility are normal. Until recently, markets largely dismissed the possibility that the new administration might intentionally slow down the U.S. economy and asset markets. In our 2025 outlook, we highlighted that the implementation of fiscal policy and the sequence of negative supply shocks from immigration and tariffs before positive supply shocks from tax cuts and deregulations would create uncertainty for asset markets. Treasury Secretary Scott Bessent also recently added that there will be a natural adjustment phase before we transition from public spending to private spending. The market and the economy have become reliant on government spending, and there will be a necessary detox period as we shift away from that reliance. Contrary to the optimistic official stance from the administration, bond traders are displaying a more cautious outlook. There has been a notable increase in the purchase of short-dated treasuries, while the 10-year yield has also decreased by roughly 50 basis points to 4.25% in roughly 6 weeks. This trend suggests that bond traders are more focused on long-term growth concerns, despite high inflation expectations driven by tariffs and immigration policies. While the likelihood of a recession remains low, signs of economic slowdown are emerging. The Atlanta Fed's GDP Now model projects a 2.4% contraction in the economy for the first quarter. Although this headline figure may seem alarming and has been used by pessimists to argue for an imminent recession, the underlying details are less concerning. The sharp contraction is primarily due to a significant trade deficit at the beginning of the year, which subtracted approximately 3.5% from GDP as businesses increased imports ahead of Trump's tariffs. Despite these headlines, there are reasons to be cautiously optimistic. The ISM Manufacturing Index, a key indicator of manufacturing health in the U.S. economy, just posted its first positive print in over 29 months. People's Bank of China appears to be addressing their own economic challenges through various balance sheet activities, and the recent loan officer survey reports an uptick in credit demand and perhaps peak tightness in the willingness to lend. In times of uncertainty, focus on your long-term financial goals and focus on portfolio diversification. Ensure your portfolio includes a healthy mix of different types of investments, such as stocks, bonds, commodities, precious metals, and cash. Diversification means investing in asset classes that don't move in the same direction, which ultimately can help mitigate some risk in the portfolio. This principle also applies to the equity portion of your portfolio. Avoid being overly concentrated in one sector, industry, or style, like the technology sector or all U.S. growth stocks. By spreading your investments, you can better navigate market volatility. In conclusion, while official statements from the administration remain optimistic, bond market behavior and broader economic indicators suggest a more cautious outlook in the near term. Furthermore, policymakers may need to act more decisively during this period of economic weakness to prevent a deeper U.S. growth scare. Within portfolio construction, remain diversified and focused on your long-term goals. Thank you for watching, and be sure to tune in to our next edition of A View from the Street.